So when we're looking at M&A in the market right now, there's a real temptation to look at some of the headlines and conclude that deal making's fully back, which is what we anticipated at the end of last year and also predicted for this year. At one level, it's very understandable. 2025 finished at more than 4.8 trillion dollars in deals being done globally, and this is really the second highest year on record, with 70 deals more than 10 billion and cross-border deals up 46%. So coming into 2026, the expectations in many parts of the market was that this would carry through into a strong and perhaps even a multi-year recovery cycle. Of course, when we then started 2026, um, we saw at the beginning of the first quarter some strong deal making coming through. Globally, Q1 was above 1.2 trillion, 22 deals above $10 billion. And that was a particular quarterly record. But if we look at deal count, it was down 17% year on year, although value was up 26%, and 29% of the quarter's volume came from equity stake purchases rather than traditional control stakes. So if we then look at this, we see a turning point of really a widening and divergence, not truly a uniform recovery. So my starting point is really this, in that we're not looking at one M&A market on a global scale. We're looking at several M&A markets moving in at different speeds and in different directions. At the top end of the market, you've got your large strategic transactions, and they are clearly happening. Boards and management teams are still willing to move where the deal logic makes sense. Cross-border M&A up 47%. And this is really the highest since about 2002. We've seen that advisors have been quite explicit that CEOs and boards are not waiting for the perfect conditions anymore, but they're progressing with deals. They're looking for scale, capability, local footprint, strategic protections in a much more fragmented world. But when you then put this next to, and it just came out earlier today, next to Bain's mid-year report, I think a much more nuanced picture emerges. We see from Bain report that they sort of note that recovery is deferred again. And in its view, the private equity market entered 2026 expecting improvement, only to be hit by three fresh shocks in quite a quick succession. So the first is that the AI disruption in software, redemption stress in your private credit markets, and then the continued war in Iran, with its implication on the oil price. And these shocks really widened that bid-asking spread. So it caused investment committees to also pull back and stalled some exit movement, even though the debt markets remain open and dry powder is still available. But what we're saying is the market is functioning, but confidence is highly selective. And for me, this is really key, and it's a real key distinction. So corporate M&A is still moving because many boards, the strategic rationale is stronger than the discomfort created by volatility. And in fact, in some of the recent market commentary makes it quite clearly that companies are learning to operate in this volatility rather than wait for it to disappear. And again, this is a very different mindset from the one we saw earlier, and during earlier bouts of disruption. It means that boards are increasingly recognizing that standing still is not a neutral choice. It's a strategic choice and sometimes also a risky one. On the private equity front, dealing with much harder equation to balance. We see again from the Bain report that buyouts are arguably as expensive as they've ever been, because entry multiples and financing costs are still elevated. Its deal cost index is in record territory, and it's we also see from the report the NDA data suggests that deal activity may plateau through July rather than snap back into the broader base recovery that was projected. And this is a very important signal. It tells us that the issue is not merely whether capital exists. The issue is whether investors can underwrite enough growth, resilience, and exit potential to justify deploying capital at today's prices. Technology is probably where this divergence is most visible. AI is driving some of the biggest deals in the market. We saw 4 of the 6 largest Q1 transactions were tied to companies that are seen as winners within the AI race. We see from the Bain report also that on the other side, it's the same story. Global technology buyout deals fell 70% from Q4 2025 to Q1 2026, and private equity software markets fell roughly 8% in that quarter, 9% in the US and 4% in Europe. So AI is not simply fueling deal activity. It's also repricing risk, compressing confidence, and forcing investors to rethink which business models are truly durable. And again, here we see that matters how buyers look at the whole sector. We see from the Bain report that some firms are rotating capital towards businesses with physical and labor-intensive components, or with more domestically orientated revenues, because those businesses feel safer and easier to underwrite in a period of AI disruption and of course, geopolitical noise. And I think one of the most important insights from the whole report is this market sector labels matter less than underwriting confidence. So what buyers want is not just growth, but they want visibility, defensibility, and a clear line of sight to value creation. The other issue sitting beneath all of this is liquidity, and this is where the report is specifically useful, because it reminds us that the real challenge in private equity and mergers and acquisitions is not getting deals done, but it's getting cash back through the system. So exit activity remains constrained. Distributions as a percentage of NAV imply roughly a 7-year capital cycle, and the majority of assets in buyout portfolios were acquired in 2021 or earlier. We see from the report that 1 in 5 LPs are reducing buyout allocations due to liquidity pressure or concerns about long-term returns. So even where there's belief in the asset class, there's still a restraint in this flywheel. Now, if we get to valuations, that doesn't mean that valuations are fictitious, or that the method is even broken, but we see that about 75% of buyout assets are still exiting above the next to last quarterly mark, which suggests realized values have held up better than many LPs really feared. But it does mean that liquidity is taking longer, and fundraising remains very, very sluggish, and pressure on managers to prove marks, crystallize exits, and generate distributions is rising. Recent market development suggests that liquidity story is now moving into a much more sensitive phase. Reuters reported in June that Partners Group capped withdrawals from an 8.6 billion evergreen private equity fund after redemption requested exceeded 5% of NAV. We also saw Blackstone capping withdrawals from its flagship credit fund after requests reached 10% of shares. In the US, direct lending issuances fell 40% in the 3-month ending May, and lending to private equity-backed borrowers fell nearly 37%, and direct lending tied to leveraged buyouts fell 34%. And that tells us that financing is still available, but it's not available with the same ease and confidence and momentum. That's really a very different market we're dealing with. So, with this as the context, what should we be doing? I think, firstly, corporates should be treating M&A as part of an active portfolio strategy, not as an opportunistic side exercise. In a market like this, the winning acquirers are the ones, uh, not the ones chasing volume. They're the ones that know exactly what capabilities they need, which geographies matter, where they need local footprint, and what strategic position a transaction creates. The rise in cross-border deals tells us that companies are not just buying growth, but they're buying resilience, they were buying proximity, they're buying relevance, and in key markets, and that's a different level of strategic intent. Um, Secondly, I think companies should not wait for perfect clarity. It doesn't mean you have to rush into bad deals, but it means recognizing that clarity really arrives at all at once. We saw the inbound UK deal making. I think it's a very good example of how capital moves where strategic rationale and valuation opportunity really meets. Reuters reported that UK targeted M&A had already reached 192 billion by mid-May, with foreign takeovers accounting 86% of that value. So buyers are active where they can see asymmetry in their favor. So boards elsewhere should be asking, where is that asymmetry? Where does it exist for them? I think thirdly, companies also need a sharper integration and execution mindset. In more volatile environment, the value of a deal is not determined just by its signing, it's determined in the first 12 to 24 months after closing. If your thesis is about scale, about synergy, capital transfer, or geographical expansion, then leadership, your operating model readiness, decision speed, and cultural execution matter more than ever. So my view is that boards should be spending less time asking whether M&A is generally back, and more time whether their own organization is actually ready to absorb and realize value from a transaction in the current environment. And this is an inference from where the market is placing its bets, on convictions and not on optionality. If we're thinking it from an investor lens, we see, and this is also where Bain's line that 12 is the new 5 becomes so important. So 10 years ago, a deal could work with a modest EBITDA growth and some help for multiple expansion. But we see from that in today's market, to generate 2.5 times return over 5 years, you may need something closer to 12% EBITDA growth. And that's a very different operating challenge. It means value creation has to be real, not assumed. It has to come from operational improvement, from pricing, from sales effectiveness, product evolution, better capital discipline, and increasingly also AI-enabled redesign of workflows and business model. And we see from the report also the emphasis that AI should not be treated as a side project. The firm and the portfolio companies are seeing greatest benefit is not merely layering AI onto existing processes, but they're redesigning workflows, improving data foundations, changing operating models, and finding new revenue opportunities. So year two in action is now a strategic choice for investors. That means AI diligence has to go beyond technology risk and into the economics, the pricing, the architecture, the customer behavior, and competitive position. And this is where uh, I think if we look at it from a portfolio management perspective, the guidance from the report is not to get caught in the middle of a holding period and focus on scarce resources. Um, this really strikes me as exactly the right moment. So long hold periods create fatigue, initial value creation, plans lose momentum, management tires, incentive structure weakens, and in that context, sponsors need to re-underwrite assets, refresh the value creation plan where there's still credible path, and be willing to exit or deprioritize assets where the path is no longer compelling. Not every asset deserves equal attention in this market. Concentration of efforts may create more value than equal distribution of efforts. So a very interesting position for investors and companies and portfolio managers to be. I think for both companies and investors, need to become much more disciplined about liquidity, timing, and communication. LP tolerance for markdown is limited. Continuation vehicles are getting harder to execute, and fundraising remains tough outside of the top performers. We see the recent credit and evergreen redemption pressure only reinforces this. So realism matters, transparency matters, and a credible plan to generate cash matters. In a slower capital cycle, trust is built uh, by not pretending the fog is gone, but by showing that you know how to operate through it. So if we think about where we're standing now, I think M&A in 2026 is active, but it's not indiscriminate. The top end strategic market is open, cross border activity. Strong boards are moving where they see scale, capability, geographical advantage. But private equity and private credit are still working through a more difficult reality, expensive buyouts, slower exits, stretched holding periods, liquidity pressure, and far more demanding tests for value creation. And the winners here will not be the firms that assume broad, easy recovery has arrived, but will be the ones that understand the divergence, the sharper strategy, the underwriting risk. Um, Honestly, improve assets operation and act decisively only when they are genuinely positioned right to win. And this is true for boards as well. It's true for management teams, and it's absolutely true for investors. So as we take stock of the middle of the year, and also largely driven by the latest Bain report on mid-year M&A review, definitely interesting environment we have faced the last 6 months, and we continue to face a very interesting environment. Hope you found the session insightful, and we'll talk soon.